If you followed the financial markets at all in 2025, you might be, well, a little shocked by the numbers we're about to share.
Mm-hmm.
The big story of last year wasn't Silicon Valley tech, even though the Nasdaq was up a very respectable 21%.
Right, a good year by any normal standard.
And it wasn't just the classic flight to safety. I mean, gold surged an impressive 60%.
Which is a huge move for gold.
But no, the single best performing mainstream asset, the one that sort of came out of nowhere, was silver. It skyrocketed an unprecedented 147%.
In just 12 months.
Yeah.
That's essentially tripling in value. And it's pushed silver prices back over $80 an ounce again, which is getting very close to its historical inflation-adjusted peak.
Yeah.
And when you see an asset move like that, with that kind of explosive, almost chaotic volatility, it really demands a serious analysis.
Absolutely. So our mission today is to get into the really complex drivers behind this incredible surge. We're going to need to dissect the competing investment theories, assess the, frankly, serious risks, and lay out the institutional price forecasts for 2026 for you.
Where do we even start?
Well, what exactly led to this extreme price movement in the first place?
To really get why it's so volatile, you have to start with what makes silver so unique. It's basically the only commodity that lives in two completely different worlds at the same time.
You're talking about its dual identity, right?
Precisely. On one hand, it's a monetary metal,
Mhm.
a store of value, a safe haven, an inflation hedge, all the things you think about with gold.
Okay.
But on the other hand, almost 60% of its entire global demand is driven by high-tech industrial use.
So it's not just a hedge against, say, geopolitical risk. It's also a direct bet on the clean energy transition, on AI, on all these new electronics.
Exactly. And that dual role, that's the source of both its massive potential for growth when those drivers align like they did in 2025,
Yeah.
and its extreme vulnerability to volatility when the industrial side clashes with the monetary side.
Okay, so let's unpack that surge then. Silver had been lagging gold for years. How did it suddenly manage to nearly triple in one year when so many analysts thought that rally was, either impossible or already over?
You have to start with the monetary tailwinds. That's what created the initial energy, the confidence for investors to really jump in. The surge was first fueled by classic safe haven demand.
Right.
Global economic uncertainty, geopolitical turmoil. We saw gold and silver hitting new records after events like the instability in Venezuela, after President Maduro's removal, and just the increasing unpredictability from the U.S. Foreign Policy Administration.
And the monetary backdrop from the Federal Reserve was crucial here.
It was. All through 2025, the market was pricing in Fed rate cuts, projected for late 25 and then accelerating into 2026. And that dramatically lowered the opportunity cost of holding silver.
Can you just break down what opportunity cost really means for someone listening?
Sure. If you hold physical silver, it doesn't pay you anything. In fact, it costs you money to store it. So if you can put your cash in a safe treasury bill and earn, say, 5%, the opportunity cost of holding that non-yielding silver is high.
Okay, got it.
But if the Fed is cutting rates and that T-bill only pays 2%, suddenly silver looks a lot more attractive. The difference in potential return has narrowed. And that expectation of lower real interest rates, that provided a huge baseline for the metal.
So money was looking for safety, but this price explosion wasn't just about paper money. It was backed up by structural physical realities. And this is where the story seems to really change from past rallies.
That's the critical difference this time. It's why this shortage thesis is so compelling. The physical market is structurally tight, and it has been for about half a decade. We're projected to face a severe global supply deficit of somewhere between 95 and 120 million ounces in 2025.
And just to put that number in perspective for everyone, that deficit, that's roughly 10 to 12% of the entire annual global demand. That is a huge gap.
It's a massive gap. And what's crucial to understand is that this is the 5th consecutive year of a shortage. The cumulative consumption over the last 4 years has already outstripped global production by almost 700 million ounces.
Wow.
That metal has to come from somewhere, which means you're just drawing down existing inventories year after year.
And on top of that shortage, the supply side itself is actually contracting. Global mined silver production is already down 12% from its peak in 2020, which just makes that deficit worse. So let's look at what's eating up this supply, the industrial accelerators.
There are 3 huge drivers, and they all come from this clean energy and digitalization transition. First, and by far the most dominant, is solar, PV. That sector alone is now consuming over 25% of the annual global silver supply.
A quarter of all silver.
It's the single biggest industrial tailwind, period.
Then you've got this enormous global build-out of AI and electronics infrastructure.
The scale is just staggering. Global AI infrastructure investment is projected to top $500 billion in 2025.
Hmm.
Now, copper gets a lot of the press for this, but the sheer volume of server components, wiring, all the high conductivity connectors, it drives up demand for related metals like silver by an estimated 15%.
And finally, the EV sector.
Right. Electric vehicle sales, they're expected to hit 20 million units in 2025. And EVs are just packed with conductive materials. While each EV uses about 60 kilograms more copper, that massive pull on copper creates this powerful indirect pressure across the whole industrial metals complex. And that includes silver.
Now, this is where it gets, for me, really interesting, because as these prices are skyrocketing, industrial users are not just sitting back and taking it. There is a serious long-term counter-narrative happening. Manufacturers are fighting back.
They are. The term for it is thrifting, and it's happening aggressively, especially in solar, the biggest consumer. It's fascinating because despite a record number of solar installations expected globally, some analysts are actually forecasting that total silver demand for PV might decrease by 5 to 7% in 2025 and 2026.
Wait, hold on. If installations are booming, how is total silver demand going down? That sounds completely contradictory.
It's a testament to the speed of innovation in solar tech. Manufacturers are just getting incredibly good at using less silver per individual cell. They're shifting to new N-type cells like Topicon and HJT, and they're replacing the older technologies.
And what makes these new cells different?
They use these incredibly efficient technologies like multi-bus bar or copper cord pastes. So think of bus bars as the little conductive wires on the cell. Instead of thick strips of silver, they're using multiple very fine strips, or even replacing the silver core with copper to slash the amount of silver needed while keeping the efficiency.
Okay, so how much of a reduction are we actually talking about here? Can you give us the hard numbers?
The numbers are impressive. We're seeing silver loading for mainstream T-Topicon modules down to about 8 milligrams per watt. For HJT, it can be as low as 6.39. Now, to put that in context for you, just 5 years ago, usage was closer to 12 milligrams per watt.
So that's almost a 50% reduction.
It's a 40% reduction in silver per watt. This thrifting is a huge long-term structural risk to the industrial side of the silver story.
That innovation is a huge factor for the long term, absolutely. But it doesn't explain that 147% spike in 2025. For that, we have to look at the unexpected, severe supply-side shocks, these policy decisions that just threw gasoline on the fire.
This is the geopolitical angle that really drove the short-term squeeze. The first major shock was a policy decision in the United States. In late 2025, the administration designated silver as a critical mineral.
And what's the implication of that? Why is that label so important for the price?
Well, that label signals its strategic importance. But critically, it instantly raised fears of high import tariffs, potentially up to 50% on imported silver. The idea was to encourage domestic supply.
And the market's reaction wasn't just talk. It was immediate and physical. It broke a decades-old system.
It triggered a massive, geopolitically driven migration of physical metal. Traders, terrified of these potential costs, started moving enormous volumes of silver from London, which is the historical global clearing center, to COMEX warehouses in New York.
Just to lock in the lower costs before any tariffs hit.
Exactly. But in doing so, they effectively drained the London Metal Exchange inventories to decade-long lows. It created a vacuum.
So you've got millions of ounces flying across the Atlantic, creating this liquidity crisis in London. And while the West is shuffling its inventory, China, a massive supplier, adds another layer of friction.
That's right. Effective January 1st, 2026, China implemented a new export licensing system for silver and also for other metals like tungsten and antimony. Now, since China accounts for 60 to 70% of internationally traded refined silver, this move was profound.
That's like taking 2/3 of the world's accessible flowing supply and just putting a government permission slip on it.
Precisely. It immediately forces every Western buyer, industrial or investor, to compete fiercely for a much smaller pool of non-Chinese shipments. the price tension just ratchets up immediately.
So if we look at those two policy events together, the U.S. designation causing the inventory to move and China's export restrictions, they essentially shattered what used to be a single, unified global inventory system.
That's the perfect analogy. It's like a traffic jam where half the lanes suddenly get shut down, and the lanes that are left are being policed by two different competing authorities. And that physical scarcity, that tightness in key markets like London, combined with huge inflows into silver ETFs, that's what amplified the price movement into a powerful short-term squeeze.
And let's just touch on the immediate catalyst that pushed the price back over $80 in January 2026. What was that final push?
That last jump was a perfect storm of safe haven buying and monetary policy expectations. The weak U.S. December jobs report, showing only 50,000 jobs added, it just intensified bets that the Fed would have to start easing monetary policy even faster.
Economy looks soft, the Fed cuts rates, precious metals look better.
Exactly. And you combine that dovish outlook with renewed geopolitical tensions, the fallout from Maduro, the rhetoric towards other regions, and it just reignited aggressive safe haven demand.
So for investors who are listening to this, it really raises the question of how to get exposure to this highly volatile, dual-purpose metal.
There are really three main ways, each with a different risk profile. The most direct is just holding physical silver bullion or coins. That carries no counterparty risk. It's the purest play.
And then there are the more modern liquid ways.
Yes, the ETFs. And here it's worth noting some differences. A fund like the Sprott Physical Silver Trust, or PSLV, is structured differently from others. It's 100% backed by actual allocated London good delivery bars. For some U.S. investors, holding shares in a trust like that can offer potential tax advantages versus traditional ETFs. So it's worth looking into those structural differences.
And lastly, for those who really want that supercharged exposure, there are the mining stocks.
These companies, like First Majestic, Hecla Mining, Pan American Silver, they offer what's called beta exposure. Their profits are highly sensitive to marginal price increases, so their stock prices tend to move much, much faster than the underlying metal. We saw that in 2025 when the stocks of these major silver miners more than doubled.
Given that explosive growth, let's talk valuation. Let's get to those 2026 price targets. What are the major institutions forecasting after such a historic year?
Well, the forecasts are all over the map, which just reflects how polarized the market is. You have the bulls who think the squeeze continues and the bears who think a major correction is coming. On the bullish or spike scenario side, you have Goldman Sachs. They're projecting silver in the $85 to $100 per ounce range for 2026.
$100 would be an incredible psychological milestone.
It would. And Citigroup is even more optimistic under certain conditions. They see a potential spike towards $100 to $110 an ounce in the second half of 2026. But that scenario really relies on the supply tightness persisting and the Fed easing policy aggressively.
But those are the spike scenarios. What's the more conservative average expectation?
Other banks see silver averaging more in the $60 to $72 range or consolidating around the $75 technical level. That suggests a belief that while the structural shortage is real, the pace of the spike was just unsustainable and we need a period of stabilization.
This brings up the single most important question for any potential investor. What are the big risks here, given silver's history of these dramatic collapses? Because historically, these big spikes have been traps, right?
That is the elephant in the room. The speculative bubble risk. Silver is notoriously sensitive to regulatory intervention. We have to remember history here. The two previous major price spikes, the Hunts brothers in 1979 and the run-up in 2011, were both driven heavily by leveraged speculation.
And what killed the rally both times?
Regulatory intervention. In 2011, the commodity exchanges just raised margin requirements by a massive amount, a cumulative hike of 150% in a very short period. It just broke the back of the leveraged speculators. They were forced to sell, and the price crashed violently and quickly.
So a massive margin hike from an exchange is the biggest, most unpredictable wild card. What about the longer-term fundamentals?
The success of industrial thrifting is a huge structural risk. If solar manufacturers get even better and faster at reducing silver usage, if they can cut consumption by, say, 15 or 20% faster than installations grow, that industrial demand tailwind could weaken considerably. That's more of a slow-moving foundational risk.
And finally, the geopolitical risks that fuel this rally could just as easily unwind it.
Precisely. A resolution to the U.S. tariff debate. A clear ruling that tariffs won't be implemented. Or if China stabilizes and opens up its exports again, that could allow global inventories to normalize. If the metal starts flowing freely again, that physical squeeze just vanishes. and that could lead to a significant rapid price correction.
So as we synthesize all this, what is the core conflict that's really defining silver's outlook for 2026?
I think the outlook hinges entirely on a fierce tug of war. On one side, you have these powerful structural factors, the persistent physical deficits, the relentless clean energy demand. On the other side, you have highly speculative factors, extreme price momentum, ETF flows, and the constant threat of regulatory intervention. So the price is fundamentally supported, but it's also highly exposed to volatility from human emotion and policy.
Silver's extreme price action in 2025 really illustrates a broader financial phenomenon, the search for maximum leverage beyond the established leaders. Just like investors look past the huge tech stocks for smaller, more volatile AI players to get amplified exposure, silver is now acting as the highly volatile beta play on gold. So the question now is, can this speculative fervor, which was fueled by all this geopolitical disruption, can it be sustained? Or is history just destined to repeat the dramatic collapses we've seen in past silver bubbles when the regulators finally decide that enough is enough? We hope this exploration has given you a clearer view of the powerful and complex forces shaping the silver market. We encourage you to continue to watch our next release.